Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers around the house. Welcome to this week's Mortgage Minute, coming to you from Palm Springs, greater Coachella Valley area. I think fall is finally upon us. Looks like the one teens that are common here in the Palm Springs area are in our rear view mirror. We're actually below 100 degrees, so getting kind of chilly, relatively speaking. It's going to be a fun week going to the end of the week. If you're a tennis fan, the much anticipated semifinal match, Djokovic versus Alvarez, that's tomorrow. So looking forward to seeing that. Unfortunately, yet again, we're not going to have a U.S. Male tennis player in the final. Been over 20 years since that's been the case. We still have some hope on the women's side. And of course, I think we're getting ready to start the NFL season. So, and then, of course, I mentioned last week, I'm a baseball guy. So this next month and going into October, it's going to be fun with baseball finishing up and going into playoff baseball, and then with the NFL getting fully into their season. So with that, let's go ahead and give you our updates on the mortgage and bond market. First, we pull up our rate grid from our website. And you may have heard, and we're going to talk more about this in a minute, there's a lot of news stories now about how rates are dropping, and there seems to be a little bit more of cautious optimism that maybe there's finally some things happening that are going to help home buyers get more affordable financing. When you look at our rate grid, what you can see there, our rates are very good. In fact, they are better than what you hear on the news media. The headlines, I still see headlines saying that the mortgage market's around 6.5%. Well, not quite true. We're closer to 6, about 6.1 on a conforming fixed rate. And that includes not just the 30-year fix, but also with temporary buy downs, 2-1s or 3-2-1s. FHA now is down to 5.5. And then, of course, VA is right behind that at 5 5/8. And look at that 15-year, only 5.25. Now, obviously, when you're on a 15-year term, even with that lower rate, the payment is going to be higher. And jumbos are looking pretty darn good. In fact, you can get a 30-year fixed jumbo at a slightly better rate than a conforming loan. Here in the Riverside County area, our maximum conforming limit is 806,500. So anything over that is considered a jumbo, whereas in other counties like San Diego, Orange County, LA County, the conforming limit is higher than 806,500 because those counties have a high balance conforming category that we here in the Riverside County or San Bernardino County or Imperial County don't have. And then the 7-1 jumbo arm is really attractive at 5.75. So somebody who needs a jumbo loan and they're pretty confident that they're not going to keep the loan past that 7-year fixed period, shoot, why not take a 5.75 rate for 7 years? So that can be a very good option for a jumbo buyer. We're going to go ahead and show you now. Jeff's going to pull up the 10-year bond yield chart. And this is looking pretty nice. Look at that, down to 4.16. So that's very good. Although, as we'll comment in a minute when we get into our discussion topic, that's not as low as it's been in recent times, but it's certainly, as you can see toward the end of that chart on the right, a nice decline from midweek. Wednesday was not the Wednesday dip that Jeff used to have a theory was going to be the case all the time. That was more of Wednesday hump, the hump day. But then nicely dropping off to where you see it now, 4.16. This chart, again, goes back to last Friday. It's a 5-day chart. So again, that's good news. A lot of sort of optimistic news about rates in the news media, the business reports, and so forth. So let's kind of get into first what is going on in the mortgage market, the bond market, data points. What is causing this drop off in these yields on 10-year 10-year treasuries, and then as well with mortgages? Well, this week is, of course, short week because of the Labor Day holiday. The markets weren't open until Tuesday. And the focus this week in terms of data points, it's all about the labor markets. So that's what I'll cover here. The first one to look at is what we call JOLTS. That's the Job Opening Labor Turnover Survey. This measures the number of job openings in the month of July is when this is released or was released. And a little bit of a drop. 7.2 million job openings versus 7.4 million in June. So of course the media grabs a hold of this and says, okay, here's an example. This index has dropped again. This number has dropped again. Hiring has stalled. Again, kind of a strong adjectives for a $200,000 drop in openings from the month of June. I'm not sure I would be that strong in saying the labor market has stalled. That's still quite a bit of job openings, but again, lower than it has been for quite some time. And remember, it wasn't too long ago that number was closer to 8 million, around 7.9. So there does appear to be less hiring going on overall. The next number that came out this week, ADP, that's the payroll company. They do a survey of job openings. I have mentioned in the past, I don't like this report all that much because I found that it can be a little bit off, sometimes way off. And again, the ADP employment report is only for private sector jobs, not government jobs. And the forecast for August was from ADP was that we would have 75,000 new private sector jobs added in August after 104,000 in July. Well, as it turns out, their forecast fell short. Only 54,000 new jobs, according to ADP, new private sector jobs were created in August. So that is part of the reason you saw on that bond chart that we showed earlier, the bond yield starting to drip or dip, because that the markets are perceiving this ADP report to be a further sign that the labor market is weakening. And of course, in the mortgage industry, in the mortgage world, sad to say, but in a lot of respects, bad economic news is good for treasury yields and good for mortgage rates. So I think we have a little bit of that going on. The other thing that was released is initial jobless claims for unemployment benefits. Now, I don't always put this on the chart every week, but I wanted to this week only because, again, the focus with all these data points is primarily the labor market. So for initial claims of unemployment benefit for the week ending August 30, 230,000 was forecast after 229 in the week before, ending August 23rd. Well, as it turns out, it came in at 237,000 jobless claims for the week ending August 30th. So a little bit higher than forecast. Now, 7,000 as to 230 forecast and 237 actual. I'm not sure I'd get that excited or that focused on the fact that that's a strong indication of the labor market stalling, but it's a little bit of an uptick, something certainly to watch. And then the remaining data points that I think are going to be of any consequence this week are tomorrow. Tomorrow is the U.S. employment numbers. Now, again, this is coming from the Bureau of Labor Statistics. You may have heard recently that's been somewhat of a controversial agency of late in terms of the numbers that they put out. But nonetheless, what the Labor Bureau of Labor Statistics is forecasting for new jobs in August. Now, keep in mind, these are new jobs in total, both private sector and government jobs. They're forecasting 75,000 in August. It was 73,000 in July. So interestingly, that this bureau is actually forecasting a little bit of an increase in new jobs over the previous month, whereas ADP had forecast a drop in August from July. So it'll be very interesting to see what the Bureau's release number is going to be tomorrow. Will it hit that 75, or possibly would it go higher? If it goes higher, then if private sector jobs really were 54,000, then that would mean a pretty good number of government jobs being created in August. So we'll have to wait and see. The other thing that the Bureau is forecasting tomorrow is the unemployment rate, and they are forecasting it to tick up to 4.3% from 4.2% in July. So that'll be interesting to see as well. And if that does prove to be the case, and if that new jobs number ends up missing the mark to the downside, we could see some further improvement in the treasury yields And of course, that could trickle through and be good for mortgage rates. What this overall shows is, remember, the Fed, their mission is two things: a full employment economy, and full employment is generally agreed to be at a 4% unemployment rate. We're only slightly above that, and then 2% inflation target. So again, 4% unemployment for what's considered full employment, because there's always going to be some portion of the labor market that just isn't looking for jobs and is going to always remain unemployed, and then that 2% target. It was only a week or two ago, the inflation numbers were kind of perceived to be ticking up a bit, and so all the focus was on the inflation number and concern that rates are going to go up because of that. And now suddenly the shift is now on the labor market, and the recent uptick in inflation numbers, to the extent they were significant, seems to be in the rearview mirror. So it's interesting how the markets kind of shift back and forth on what they react to, and oftentimes that reaction happens without regard to what was previously the case with the other sector. Now it's all about jobs, forgetting about the inflation uptick that was perceived. And then next time we get our inflation numbers, it could then shift back to that, and forgetting about the labor numbers that we're seeing this week. So we'll just have to see how that plays out. It's like I said at the bottom, on financial markets, they respond with reptilian-like minds to stimuli, and on rates, I'll continue to say higher for longer, but we are seeing some improvement, which is what we're going to talk about now. And and you can see there, our slide there, a picture of me and home sales going in the upward direction. And so, yes, that is happening to a slight degree. And in fact, there was a recent article that came out from Fortune magazine, where, and in fact, I'll read you the headline: U.S. housing market starting to listen to home buyers. So again, that's the good news that the media is starting to put out there. And I'm not disagreeing with that. I'm not going to try to be a downer here. I think there is definitely some truth to the Fortune article, and that's what we want to get into now. So I want to go over a few sort of talking points that came out of that article, and so I can give you sort of my 2 cents as what Fortune thinks is happening with the housing markets, because I think there is some reason for everyone to be hopeful, but again, be a little bit cautious in that optimism, because we still, I think, have a fair ways to go. So the first thing that the article pointed to is mortgage rates, that they're cooling, and that this is a sliver of ease for home buyers. Well, is that the case? I would say, well, yes, it is the case. Now, to a limited degree, and here's why I'll say that. The article, and we're seeing this really all over the business news, that U.S. mortgage rates have been slipping recently. And in fact, most of the headlines are talking about rates having softened to about 6.5%. And of course, you saw in our rate grid, we're better than that. We're closer to 6, about 6.1, as I pointed out on our rate grid. And I both the Fortune article as well as the other headlines I'm seeing about rates cooling down to this 6.5% level, it's, they point out this is the lowest point since October of 2024. Well, that's true, but that comment is all about what point in time earlier do you pick to make that comparison. Well, lowest point since October 24. Is that true where we're at now? Yes, we are better than October 24. But does anyone remember September of 24? Because if you remember that, we actually were at a lower level in rates than we are now. So if you recall, early September 24, it was broadcast and pretty much accepted that the Fed was going to lower the Fed funds rate by 0.5%. So there was euphoria that everyone was convinced it was going to happen, and that if that did happen, mortgage rates were going to plummet. And as a consequence, what we saw briefly was an uptick in applications. And they did do that 0.5% reduction. The 10-year bond yield did drop. Mortgage rates did drop, but extremely briefly. And by October 84, they had already gone back up. So really, this is an issue of where rates have, yes, cooled from earlier months recently, but they're actually not back to the levels they were a year ago right now, early September. So just keep that in mind in terms of the optimism. Again, I'm not trying to burst the balloon here, but understand that things are cyclical, they go up and down. And so as a consequence, you know, we've got to take this a little bit of grain of salt. The point of the article was with mortgage rates cooling, of course, it went on to say this is a lifeline for many buyers, giving them a touch more room to breathe. Well, um, yeah, I guess you could say that, but we've been at these levels in the past, recent past, and yet there wasn't this belief that buyers were getting a lifeline and that they had room to believe. For example, let me give you an example of that. April 4th of this year, even though we are, celebrating that 4.16 10-year bond yield that we just showed you, April 4th of 2025, the 10-year bond yield was 398, and mortgage rates in similar fashion were better than they are today. April 30th of 2025, the 10-year bond yield was 4.175, again, about where we're at right now. And yet you didn't really hear all this euphoria that we're now hearing about mortgage rates improving and giving buyers, this lifeline. And just a month ago, August 5th, the 10-year bond yield was just slightly above where it is right now, 4.19. So what's going on here? I think it's more about psychology of the markets and the general public, because now there's a much greater belief, and the futures market is betting on the Fed's going to lower the Fed funds rate by 0.25% this month. That, along with these soft labor numbers, are shifting the focus and changing the sentiments of the market and the general public that rates are finally, falling and giving us, all, and in particular, prospective homebuyers, some relief. So yes, that's true, but understand that in recent times we were at these levels or better, and yet we didn't have this optimism as strongly as we have now. So you kind of have to say, well, why the change now? Why is it this time people are grasping onto this, relatively slight good news and embracing it much more than they did in the past? Well, my argument would be that it's really a little bit more now about capitulation by prospective homebuyers. We've been at these levels, I've said for months, we've been at these levels for an extended period of time. I've talked about how rates have been generally very stable, low to mid sixes for months. So I think now what's going on is people are finally starting to realize they are where they are, and as a consequence, it may make sense to go ahead and get off the fence and start looking around. So again, it's not a tsunami of a change, but we've had enough of a cooling. I think now people are more willing to embrace that and realize the conditions are such that maybe it's time to get off the fence and go ahead and start looking around. The next bullet point that we would want to talk about is affordability. It is edging up, but you still have a bit of a hill to climb. And affordability has been helped a little bit by the rates that we just talked about. But again, to the extent they've helped, mortgage rates have been at levels earlier this year where they should have helped with affordability as well. But it seems like earlier this year, home buyers were less willing to embrace the lower rates that we had, not a lot lower, but a little bit lower, and use that as a reason to get out there and try to buy a home. So why is it, what's the difference now? Well, I would argue that it's more about wage growth, because one of the things that's happening, despite all the concerns about the labor market, wages have been growing. And so I think that's one factor in the fact that affordability is edging up. It's a little bit about rates. I think it's there's definitely some of it is because of wage growth. And then the other most important thing is home prices. Home prices are flattening in more markets than we've seen before. And we talked about this, I think, last week. The Case-Shiller index did show still an increase in home prices, but at a decelerating rate of increase. And that is even more so, I think, now and continues to be. Uh, that's not to say that home ownership, home affordability is not out of reach for still a lot of buyers, but affordability is edging up. In fact, the Fortune article that I'm is the basis for this discussion did point out that if there is an affordability index out there that's monitored, and affordability is creeped up 3.1%. In other words, affordability is now 3.1% better than it was previously. A little bit about rates, I think a little bit, if not a fair amount, about wage growth. And then in particular, I think it's a lot to do with home prices. The rate of increase is slowing, it's moderating, it's kind of stabilizing, leveling out. And as I've said, to try to defend the mortgage part of the home buying process, I don't think it should be so much about blaming rates. Whenever I have a conversation with anybody, realtors and so forth, in fact, I had a few of those conversations yesterday at an open house in our local caravan schedule. It's not about rates so much. Rates historically are affordable. They're better than they have been on average in the last 50 years. Forget about the pandemic. What's really been the issue, in my opinion, is the home price. The home prices are what I think are the biggest factor in affordability, and thankfully, we are seeing some moderation in those prices. Now, I'll continue to say that's not a reason I believe, given how long I've been around this business, that you should take that as a sign that you should continue to wait because you think prices are going to fall substantially. I'm not convinced that the labor market's ready to crash. I think, yes, it's going to soften a bit. I think, though, now what's happening is we're seeing more buyers starting to look around out there. And while the home prices are moderating, I don't think we're going to see a precipitous fall in pretty much any of the markets out there. So the overall, though, therefore, is what this underscores is the fact that you can have these little structural shifts in different parts of the market: mortgage rates, wage growth, home prices. And when you start to see that structural shift with some of these numbers, that can provide that sort of glimmer of hope that it may be possible to get a mortgage, buy a home, and be able to afford a little bit more than you thought you could before. The other bullet point that came out of the article, and I think this is an important one and underscores what I just talked about in home prices: growing inventory. Inventory has grown in most markets. It certainly has here in the Coachella Valley. In many of the cities, we are seeing more and more inventory. Now, is it all the way back to normal, which again, historically, traditionally, a normal market has always been considered that inventory would be about 6 months of supply based on the current sale rate. We're getting pretty close to that, still a little bit shy of that, but inventory certainly is much, much greater than it was several months ago, earlier this year, and certainly compared to last year. So I think that's a pretty big issue in terms of how affordability has ticked up a little bit. Listings are ticking upward, and because of that, the combination of all this good news about mortgage rates trickling down a little bit, I think more and more of the consumers out there, the prospective home buyer segment, they're starting to hear that listing inventory is growing. A lot of the cases, these prospective buyers have an agent lined up. They've got an agent who's monitoring the market, letting them know about new listings coming online. And they're probably hearing that the amount of listings available for them to look at has grown. So what that does, when you got more listings to choose from, then that starts to shift the market in terms of who's got the leverage. Is it the sellers or is it the buyers? Well, I think the sellers now have lost a lot of the leverage they have had because they have more competition in terms of more listing inventory of existing homes that they have to compete against. Plus the fact, don't forget, you've got those home builders out there. I always say, if you're selling your own home, the home builders are your competition too, and they continue to do everything they can to get their home sold by offering concessions in order to help the buyer with their financing to do what? Make the financing more affordable. So those folks selling existing homes, you need to realize that's part of who you're competing with. And you need to realize, as a consequence, when you're marketing your home for sale, and it's an existing home, not a brand new home, you've got to focus on what can you do as a seller to help address this affordability issue, just like the home builders do. Look around at those ads, see what they're advertising, buy downs, permanent buy downs, temporary buy downs, credits toward closing costs. That all of those things sell homes. If you're selling an existing home, realize that is true and grasp that concept. Talk to your listing agent. We can help you with that. We can help you strategize with you and your listing agent to come up with ways to market your home with that benefit, to attack affordability and help expand your potential market and prospective home buyers by taking an advantage of that strategy. Um, and so, that, and the other thing I would point out, and I just wrote this down, there is therefore more to pick from, and therefore potentially more leverage as a buyer. Um, and I know it sounds like a broken record. I keep saying that. This year, 2025, right now, that's true more than it's been all year, and I can't stress that enough. So you got to focus on that. If you've been waiting to buy a home, I really do think we're finally at a point where put all this together, rates trickling down, we're seeing more wage growth, home prices moderating. Put all those together, the environment's perfect to start realizing it could be a good time to buy. And then the last thing, though, that I want to point out from this Fortune article and the whole idea of, is the market speaking to prospective home buyers? Be cautious. As the article mentioned, Goldman Sachs still predicts persistent rate challenges. And of course, in that regard, what you want to realize, Goldman Sachs is still projecting that by the end of the year, mortgage rates, conforming 30-year fixed mortgage rates, aren't going to be at 6.5, as we talked about earlier. They're going to be at 6.75. Well, that's interesting, right? You've got all this news currently, all this optimistic news that affordability is improved, rates are trickling down, home prices are moderating, wage growth is there. Now's the time to buy. But yet, what is Goldman Sachs saying? Watch out. By the end of the year, rates could be higher than they are now. Well, why would that be the case? Well, number one, it could be the labor market, though showing some signs of softening, isn't going to crash, isn't going to have a rash of unemployment situations and a big uptick in the unemployment rate. And I don't see that coming. But on the other hand, and again, it gets back to full employment, labor market focus, inflation, 2% target, the inflation focus. For rates to go up from here, even with the predicted reduction in the Fed funds rate in September by 0.25, why would Goldman Sachs say that rates could be higher at the end of the year? Well, lingering in the background, you probably know what that is. Probably concerned that tariffs, which are still in the news, could eventually filter through to the inflation numbers, causing inflation to go up. And then what will happen? The focus will shift back to inflation and forget about whatever evidence of a softening labor market is happening. Go back to the inflation focus, and we see further uptick in the inflation numbers in the next couple of months. That could undermine this, slight optimistic improvement of rates trickling down. And I'll give you a perfect example in case any of you had forgotten this. What happened a year ago? The Fed lowered the Fed funds rate in mid September of 24 by 0.5%. And again, there was very brief euphoria about that. But then what happened? Within about a month and a half, the 10-year bond yield, which had gotten down to 3.61, was well back over 4, and mortgage rates actually went up 1% after that 0.5% reduction by the Fed a year ago. So could that happen again? Absolutely. So you have to tread lightly here. You have a window of opportunity. You have the ability to take advantage of these slightly lower rates. You now have, as a home buyer, more leverage to negotiate an offer at a purchase price where I always say offered at or near full price, but then get your leverage from the seller, not through a lower price, through concessions. Use that to attack the affordability of your financing even more. And that, combined with the fact that you may be making more money now than you did before, right now the window's there, but it may not last. And again, I'm not trying to be, to create, urgency or fear that this window could close, but it could. We saw it a year ago. Could happen again. So why wait? if you've been waiting for a long, long period of time, all these conditions and you put them together really um, can't be missed, I think. I mean, it's tantalizing. Again, I'll put it right here. Rate relief might be tantalizing, but affordability won't rebound unless rates drop substantially. So, and that's just not guaranteed yet. So that's why you have to consider, with rates softening, as Jeff just put up there, and options rising, the door to home ownership isn't wide open, but it's cracked. So why not kind of push that crack a little bit and take advantage of that while you can? Because if it turns out Goldman Sachs is correct, then you could be in for a disappointment if you think, okay, we're seeing the door crack, we're going to wait until the door is wide open. Well, sometimes that strategy backfires, because as you wait for that door to go wide open, what can happen to you? The door slams and you didn't jump in through that crack when you had to. And that's what a lot of folks did a year ago, particularly on the homeowner side, who were waiting and waiting and waiting to refi. And they were waiting for that 0.5% Fed reduction, which did occur. And then they lost their opportunity to refi because they thought, okay, that door cracked open. We're going to wait a little bit longer for that door to fully blow open, and maybe they'll go down even more. And what happened? It reversed and went the other way. So when you put all that together, there's an opportunity here, but it's a crack in the door. Don't overlook it. Don't wait for that door to go wide open. If you've been waiting to buy, you need to buy, you want to buy, start looking into this now. We can help you with this. Again, I can get with you, your listing agent. We can talk about a home you're looking at, considering making an offer on, and then I can give you some advice about how to negotiate that offer, get some concession dollars, and then I can give you numbers to show you how we can apply that concession toward your financing and really hit the home run on that affordability that has cracked open with that door right now, and get into home ownership. Because you know what, even with these moderating home prices, long term you're going to be better off wealth creation wise if you get into the market now and take advantage of this door that's slightly ajar when it comes to affordability. So with that, I hope that information helps you. I wanted to give you my take on this. Again, it may sound like I'm just giving you another line about now's the best time to buy, but again, when you consider everything I just talked about, why wouldn't you realize that that may actually be true and then take advantage of it? So with that, that's going to conclude our Mortgage Minute for this week. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. I want to thank you for watching and listening. Have a good weekend, and take a look at that men's semifinal tennis at the U.S. Open tomorrow, and look forward to the opening of the NFL season. And then we'll see you again next week at the same time and same station. So long. Take care.